discussion yesterday with my counterpart at Anderson, and I think we've been approached by a few potential candidates who want to set up separate accounts in the debt space. So the debt market still attracts some pocket of capital. Clearly, again, I mean, those investors would consider venturing into the debt market, provided there is a proper kind of arbitrage in terms of trading liquidity versus higher margin, bigger spreads. So I think there is money out there. It's still interesting. Then there might be a point where if margin compression we are currently experiencing keeps on going, the arbitrage might not be that compelling. Still, so there is this point where you might no longer see any interest in those debt market if spreads are too tight. But again, remember, back in 2006, 2007, the CMBS market was out there, and most of the buyers were banks and insurance companies buying those bonds. So
it's quite interesting actually, because I think what we're seeing with actually a lot of the money that is actually coming into the banking world, that they're actually chasing the slightly higher returns and actually don't necessarily want the senior debt. They're actually saying their whole loan lenders, to then be able to take keep the higher LTV element of it and sell down the senior, which sort of starts moving back into the need, in effect, to start seeing a CMBS market in a new form coming back into the marketplace. And I think we're starting to see that. We haven't seen conduits being created yet, but there's signs that people are starting to talk about building pools and then creating a securitization. Now, I think there will be a lot more checks and balances in that process, and hopefully the underwriting of those positions will be a lot better than they were in 2006, 2007. Well, quite yes, yeah. Some of it was atrocious, but I think we will gradually see that market come back, because actually at that lower margin area that's where the crush is, or less appetite, and perhaps some of the slightly higher return.
I think, Philip, you put your finger right on it. It's chasing is the word. I don't know if you want to call it cat and mouse, or there's a sort of carrot in front of a donkey, and I don't want to use the donkey analogy too much, but it's very clear that what the institutions are doing is they see some returns, they go after them, the market moves a little bit further on, they've sort of missed that bit, they think, I'll go for the next bit anyway. And so you've got this sort of chasing of returns to try and catch something. And I think what does worry me is that they're doing it whilst they can't see liquid distribution in the form of CMBS. If CMBS comes back, I think the institutions will say, actually, I don't want the illiquid credit, I really want the bond corporate market. That's where I've always been for the last 10 years. I'll go back there. So I think there is that element. If CMBS really does return, it's another threat.
Well, they pay really for liquidity.
Absolutely.
And because they need liquidity, they need to be able to trade. Whereas just holding a traditional loan, that is a much harder instrument to trade. It's not listed and it's not rated. So it's, undoubtedly, I think we will gradually see it coming back.
I agree on that, but also I think when the banks go for the whole loan, that is also some learning from the financial crisis. It is nice to have control as a lender on the whole structure, and you have that. And that's for, I think there will be investors moving from debt funds into CMBS, but there will be more of the more sophisticated that will stay on the direct lending, because then you can have control.
So there are a lot of people that say the whole loan, and then as soon as they've done the whole loan, they then slice it.
Yeah, well, that's one thing we won't do. No, that's how we won't do. We will not break it up.
And just one comment on what you said. I mean, in terms of, again, trading liquidity for spread. especially pension funds, insurance companies have long-term, resources, and so they don't necessarily mind, deploying capital and on a long-term basis, provided they have some sort of call protection. So in this respect, I mean, there might be a market segmentation as well between, longer-term kind of, facilities versus, shorter-term, credits, and so I think that space could be occupied by those insurance companies on these kind of products. So
part of the difficulty with that is actually the vast majority of borrowers. Everybody wants duration. Fantastic if you can get it, but most people that buy property have a 3 to 5 year time plan. Institutions would ideally like to lend 7 to 20 years.
That's right.
And there is a mismatch between.
I think there is a solution to this. And again, going back to the US model, a lot of the debt funds in the US started life, as they have done in Europe, as closed-end funds. They then converted to open-ended. Now you can't start a debt fund on an open-end basis without holding massive liquidity. But what you can do, as you come to the end of that life, or certainly halfway through it, you should be looking at converting the fund to open-ended. Because what that does, it offers the institutional investor, whether they're insurance companies or pension funds. Let's not forget, pension funds love long-term credit. They love illiquid credit. But it gives them an element of liquidity because they can then do a redemption. So if you can manage a redemption process, which you can't in the early years of a fund, then you've got something that's actually very interesting for the market.